What we have here is the balance sheet for the joint venture. Whilst the joint venture doesn't provide formal financial statements, it has to provide enough information to the venturers so that they can satisfy the requirements of AASB 131. The other two statements which you'll commonly see, the cost of production statement and the cash flow statement, I've not included for this example as they're fairly simple. What we've got here is the balance sheet, and it picks up the cash balance, which is the $400,000 that the venturers put in, less the $250,000 for land, and less the $100,000 for the payment for expenses. Inventory, they produced $500,000 worth of, or there were $500,000 worth of costs put into the inventory, and 70% was dispersed, which means 30% was kept. So 30% of the 150 of the $500,000 gives you 150. Land was purchased for 250, and land, we're not told anything else about it, so it stays on 250. And equipment is $600,000. Now, a note about equipment is that even though it is a depreciable asset, the joint venture doesn't actually do the depreciation in its own books. The depreciation will be dealt with by the venturers in their books. So the equipment put in at $600,000, and that's what it's left here at. We will deal with depreciation at a later stage. They incurred $400,000 in liabilities, leaving $650,000 in net assets, or the equity balance, and a total amount of liabilities and equity of $1,050,000. Also, we see we have a fair value of $650,000.